That my cue when you close the doors? All right. Appreciate you having us. Mark Crossman, the CFO of Playboy, our PLBY Group. I'm just going to run you through what our company does. We've made some pretty big transformations over the last couple of years. So I would argue that we're one of the most recognizable brands in the world. We've been around for 72 years. We have over 90% unaided awareness. It spans everything from the young to the old. Your parents have probably heard, well, it depends upon how old you are, have heard of the brand. And so we really do have that cross-generational appeal. So why invest in the company? First of all, we do, excuse me, we are a globally recognized brand. It's impossible to replicate. If you tried to replicate Playboy today, it would cost you billions of dollars. We do have a stable base of high margin recurring licensing revenue. Right now, we've transitioned the company where we no longer operate assets. We're a purely licensing company. About 86% of our revenues in 2025 are going to come from guaranteed minimums. We do have a lot of growth prospects, both in new categories and new geographies. We'll explain this in a minute, but most of our revenue comes from the US and from China. On the licensing side, we think there is, because we're a globally recognized brand, that there is plenty of room for geography expansion. And then also categories. We're very category specific in accessories and apparel. And we believe there's a lot of room to grow into other categories. The company historically had been in other categories. We had lost that. And so we have a strong pipeline to get into other categories again. We think we're going to be pro forma cash flow positive this year. I say pro forma because we did a pretty transformational deal recently with Byborg. And we have a transition services agreement that has us take on about $5 million worth of costs as they take over our operating businesses. But pro forma for that will be cash flow positive. And then we have one asset left that we do operate. It's Honey Birdette. It's a lingerie company. We think there's a lot of asset value there. We'll talk about that in a minute. 23 and 24 have been really transformational years, or actually years that we've spent a lot of time trying to get that business back to a healthy position so that we can ultimately sell it in some way, shape, or form. All right, so we are emerging from a multi-year transformation over the course of 2023 and 2024. We've talked about shifting to an asset-light model. What that means is we want to be a licensing company. We don't want to operate businesses. The last peg in that ladder was licensing our adult operations to Byborg. We stabilized our licensing in China in 23. We lost our two biggest licensees in China, and we've now replaced those in 2024. So we have a stable business in China. We've been improving the Honey Birdette business, and we're reducing corporate overhead and strengthening the balance sheet. Really what this means is in 2025, we can focus on growth and cash flow. So shifting to this asset-light model, what we're going to see is about 40% of our revenues in 2025 are going to come from licensing. We need fewer people to run a licensing business. Everybody knows this. We just need some back office support staff. We don't have any of the operating employees. It trickles down throughout the organization. Our last remaining business is Honey Birdette. That's the only one we operate, but it's very segmented and has its own operating team. And we're going to continue to reduce our debt pending an equity investment. So what you're going to see is more licensing revenue, fewer people, and reduced debt. So as a licensing company, what do? Our main goal is to market the brand and create better awareness to support our licensees. It all starts with the content and our editorial voice. And then that pushes down through our distribution, which is social, print, we'll get to that in a second, and digital. And what that allows us to do is support our licensees. Now, whether it's co-brands, so believe it or not, we've done co-branded deals with LVMH, OVO. I don't know if any of you know who OVO is, but it's Drake. True Religion. That's my old days of denim. It allows us to also throw iconic events. I'm sure everybody's heard of Midsummer Night's Dream. We're bringing that back. We've been at Super Bowl, the F1 party, or Basel. So all kinds of events that we can do centered around Playboy. Because I know when I came to work at Playboy, the first thing when I told my friends, first thing they said were like, "Can you get me into that party?" Right? Everybody knows the Playboy parties. Um, and it's also going to allow us to bring back franchises like the Playmates, which obviously everyone's heard of, After Dark, 20 questions, excuse me, and the interviews. So we're returning to print. In February, we relaunched the magazine. I'm going to preface this. We're not buying paper. We're not manufacturing the magazine. We're not distributing it. So we're not going to do the things that we've done in the past. We've licensed it out. So the only thing we're doing is just creating the content and then pushing that out to our licensee, and they're making the magazine. Now, the magazine is not going to be a moneymaker for us. It's really about bringing in influencers, cultural leaders, people with big audiences, and putting them in the magazine. If you're an influencer or a cultural leader and you remember this brand, you remember the magazine, they all want to be in it. It's aspirational. So they're basically bringing their audience to us. They're giving us the content. We're repackaging it and then pushing it into the magazine and more importantly into social and digital. And that's how we're building our audience. So the magazine leads to this brand ecosystem that I'm talking about. And it allows us to produce the content. It goes in the magazine, but really we're focused on digital and we're focused on social. And then what that allows us to do as we build this audience is have these events that we had talked about, bring sponsors into to those events. It helps us on the licensing side with our licensees and then also co-branding partners. So it just opens up a lot of avenues to monetize. I'll give you an example. The Playmate franchise. Everybody's heard Playmates, right? Show of hands. Do we need to show hands? There we go. All right, one guy back there. I know, right? You're the only guy. It's like the step forward and everybody steps back. So with the Playmates, what we're doing is having paid fan voting. Believe it or not, 20% of the people that vote on who the next Playmate would be actually pay to do it. They buy more votes. What we can have the Playmates do is host parties. And then around those parties, we bring in sponsors. We're bringing the calendar back. We've made millions of dollars on the calendar in the past. And then we're also exploring opportunities if someone were to license a TV show. I don't know if anybody here remembers, but they used to have Playmate TV shows. Licensing is a foundation. I want to get back to this. It's a 90% gross margin business for us. All of Playboy's business is now licensed. So all of the Playboy revenue is coming in at a 90% gross margin. It takes very little fixed overhead. I think we have one salesperson and two product development people that run all of licensing. As I said, 86% of the revenues are in the form of minimum guarantees. So we're going to get paid. No matter what happens with the economy, we're going to get paid. And then we're going to unlock the growth because one of the questions I've gotten back is how are you going to grow as a licensing company? We're going to get the best in class partners and we're going to grow into new geographies and new categories. So let me talk about the last rung of the ladders I talked about before. I mentioned Byborg. Byborg came to us to license our adult business. We had 3 brands that we were operating. We're operating Playboy Plus, which is just a gallery site. We're operating Playboy.tv, which is linear television. And we're operating our creator platform. All of those businesses, if you look at the direction of the profitability, it went like this. And we're about to lose money in those businesses. I think we made about $1 million at a segment level in the fourth quarter, and that would be a loss in this first quarter. We took that entire business, gave it to them, said, you operated it. They gave us $20 million to do that, and they're going to give us $20 million a year for the next 15 years. Byborg also is taking other categories. I know no one's going to believe me, but AI dating. So right now, if you look at where the industry is going with these creator platforms, I'm not saying anyone here is on OnlyFans, but what happens is when you're on OnlyFans, it first started with the creator talking to you. Then it turned into some guy with a martini at a pool talking to you, and you think you're talking to the creator. And now it's going to AI, where AI is actually responding. So it learns from the creator what your response is going to be, and then it would deliver the response. The creator says, yes, go ahead and send that. And then the next step is they're going to cut the creator out of this whole thing. And it's literally just going to be AI. You design your own girlfriend, and you then have the conversation, and that becomes your girlfriend, I guess. I know I don't get it. I'm a 50-some-year-old man talking about AI dating. Never thought it would happen. So anyway, Byborg also is going to have the rights for live cams, which we had tested live cams, and it was very successful for us. We couldn't do it on a bigger platform because we didn't have the technology, but that's another area that they have. They have some other product categories like tokens and toys and stuff like that. Just to tell you who Byborg is, Byborg has about 80 properties, from sex.com to Gamma to Live Jasmine. Please, I hope no one's ever heard of any of these. All these sites, they have about 1,200 employees, and most importantly, they get 70 million people hitting these sites, except all of you, hitting this site. I'm in a comedy club, every day. So we're taking the Playboy brand and we're plugging into that, all their technology, all of their platforms, and the exposure. And Playboy is going to have that. We've never had that in the past in the adult business. We'd always been kind of adjacent to it. And now we're going to be able to, through them, turbocharge it. So this is what I was talking about with our global licensing reach. Right now, 50% of our revenues come from two places, China and the US. We have global recognition, and we don't make anything in these other countries. Like, we don't have that presence. And it's because we've never gone out there and really pushed it, because we've been so focused internally over the last couple of years trying to straighten the company up that we haven't really tapped that market. And, so from our perspective, and this is it's safe for work. So not safe for work. I know it's double negative. So I think just with what we're doing with CAA and bringing in licensing representatives that are going out there and chasing deals for us, there's a lot of room to be had. Because how can you say in Latin America you're generating $1 million of revenue, but everybody in Latin America has heard of Playboy? Just doesn't make sense, right? So that will be a huge area of growth for us. And then categories. So I said 80% of our revenue comes from apparel and accessories. From our perspective, the company historically had done a lot in land-based entertainment. We got paid $5 million a year by the Palms just to have a Playboy Club. We got paid $1 million in London to have a Playboy Club. Again, we haven't been going after these deals. We're going to go after these deals. There's a pipeline there for this already. Nothing that we're going to talk about right now. Same thing goes for gaming. Playboy poker tables. We did a small deal with DraftKings, but there's more behind that, and hopefully we'll have more to announce soon. But it is an area that we will have significant penetration, because now we're turning our attention to it. Honey Birdette. So Honey Birdette, when I got there in 23, they were in a position where they were trying to drive revenue. And to do that, they were buying a lot of inventory, going on sale. What we saw is gross margins came down. The company had lost money in 2023. So when I came in, we had a different strategy. It was make it a premium brand, buy less, be on sale less. Gross margins, the knock-on effect is gross margins go up and your profit, you turn profitable, which is what we did. In 25, we're focusing on growth. So we're really expanding here in the US. And what we're seeing is our sales and our stores in the US are doing really well, and we're comping up. But Ben has said, our CEO has said that we're not the right owners for that business. I look at that business and say that if we're able to show another year of growth like this, you could wipe out all your debt selling that asset. So it is definitely a business to keep an eye on. I'm not going to run through all our goals and accomplishments. They were all fantastic. It was all me. We are, the main thing is shifting to an asset light model. That was the most important thing, kind of stabilizing the business. But the core of it was us taking a business where we were operating to just being a licensing and marketing company. And I would say that we've been successful in doing that. The knock-on effect has been reducing corporate overhead, strengthening the balance sheet. All of that has come as just a knock-on effect of focusing on one thing, doing licensing and marketing. We have given guidance. It's sparse at best. We've said we're going to do 120 million in revenue. We're going to be cash flow positive, and we're going to bring our net senior debt down to 100 million. Now that 100 million is from over 200 million just a couple of years ago. IT, got an issue. There we go. Thank you. Does anybody have any questions? I was gonna say it couldn't have been that good. Yes. Okay, I think we're out of time. Yeah, the tariff situation, it's interesting because it's only the goods coming into the US. Trade between China and Australia is actually free. They don't have tariffs. So half of our business is US based, or actually 45%. So already take the other 55% of the business and say it's not impacting it. We're already paying 24.5% tariff coming into to the US. So it's really 145% bump for us. It's substantial, but when you want to quantify it, it's about $3.5 million. It's not a big number. So how do we overcome that? Because it is a number period. A couple ways. We've gone back to our suppliers and we've asked for discounts, and we're getting them. They're in the range of 10 to 20% discounts, and you have based on the price of the garment, it's a double effect on it. So you're already wiping out about half of your impact from the garments, or sorry, from tariffs. And then in addition to that, we're raising prices. It's only going to be a small price increase, about 10%. And that completely wipes out any impact of tariffs and gives you a little cushion because we're not selling blueberries. And at the end of the day, you raise prices, you'll probably see a little drop off in demand. But we're putting enough of a cushion in there that if we do see a little drop off in demand, based on the price increases, we'll still have enough room to completely, mitigate the impact of the tariffs. Is that good enough? Because there's some stuff we can do with shipping back from our garment days that can get rid of all of it. Sorry, go ahead. Byborg is arguably the largest adult entertainment company out there. They have 1,200 employees, and that's not including models and all that. We're talking about rank and file programmers, everything from age verification people, customer service, you name it, all of them. I can't tell you how big they are, but they're huge, and they generate so much money it dwarfs even the revenue we generate. They are big. So they're a partner that's credit worthy. And just to give you a sense, they wrote us a $22 million check immediately to put money in the company. They then gave us $5 million on top of that. And we've got another $20 million coming in the back in June and July. Like they're just throwing money around. So they are definitely credit worthy. Oh yeah. And then they also are giving us a $10 million, which is a pull forward in year 15 of the last 6 months. So that's a lot of money. It's more than I got. I don't know about you guys, but yeah, so it really does like a step function when we do licensing, because now we used to literally anybody would come and say, I want a license to, I don't know, to do microphones for $20,000 a year. And we take the check because we needed the money. We're not in that position now. We're in a position where we can sit back and find the right partner. That deal with Byborg took 18 months to put together. So it's not like that comes together quickly, but we're looking for those best in class partners We do have a pipeline of people we're talking to right now in land-based entertainment. I think there's a lot of desire to do stuff in LBE, as they call it. Um, and we also have a pipeline in gaming that's pretty strong right now. Yeah, the lessons learned from the previous relationships are don't work with criminals. Um, but not really criminals. I can't say that because we're in a court case with them. Um, so alleged criminals. Um, no, so the folks we're working with now, what impressed us about them, they're not signing up for the size guarantees that our old licensees were signing up for. But what they were doing is you have hologram tags, and they were taking those tags and just throwing them in a bag with a junky $6 t-shirt and calling it a Playboy t-shirt. And so we saw that going through because we sell the actual the holographic tags to them. And that's all they were doing was basically, in order to get on Tmall and Douyin and all of those websites, they had to say they were setting up a Playboy store, but they weren't selling Playboy merchandise. Um, this group is not doing that. This group asked for, Duhan, the one that we'd announced recently, had asked for lower minimum guarantees because they wanted to clean the market up. And they have not come to us to ask to bag and tag, as they call it. So we feel like they are the right partner to have. They're not doing the level that our original licensee was doing, but the goal is that they'll get back up to that after they clean the market up. Pardon? It's a long process. We're having to go through and close stores that have been put up on the internet in China, and it's not an easy process. It's probably a 2-year cleanup, and we're 6 months into it. Sign says 5 minutes, but do you have a question? Yeah. Yeah. 100%. Yeah. Yeah. So the 86% there are three things that go into our analysis. One is obviously the minimum guarantees. Two is new deals that we have in the pipeline. We're being very conservative about that, given what I know that I can't tell you guys today. And then the third is overages. And that's where we've been really, we've only been looking for less than 10% overages against those minimum guarantees, right? And that's not a big number. So when we go back and look at it historically, the overages ran into the 20s. And so we're just trying to stay conservative about it because yes, we don't know what's going to happen in this operating environment, but better be conservative than not conservative. Yeah, to operating a business. I mean, we were losing money operating businesses. We bought a few businesses that started losing money. The creator platform was very expensive for us. And we lost a lot of money on the creator platform. And then as we were scaling down the operations of the company, we weren't keeping pace with the back office. And so our SG&A got bloated from that perspective. So it's kind of everything. It's not like I can't pinpoint one thing and say this was the reason, but I can tell you every single part of the business was impacted by us shifting to this asset light model, both on the positive side, but the negative side before we got there. It is all licensing. Slap us in the head if we try and operate a business again. Our CEO loves to say, like, I don't like managing people. Well, okay, let's not have any people then. So, so, uh, so yeah, we're not going to need capital to grow. And that's the important thing because we had been through operating a business, throwing capital at it. If you're doing a website, a gallery site, you're constantly doing photo shoots, all of that stuff. We don't have to do that anymore. And the vast majority of the money we spend on licensing is success-based, working with CAA or CTL in China. So we're trying to keep the cost as variable as possible and reduce the amount of fixed costs that we have because we think that's how we'll be most successful and generate the most profit. Paying down debt. We have $320 million of NOLs. And with that kind of NOL coverage, it makes no sense to have debt. So from a use of capital, it's to me more important to delever than anything else. Can I get one more? There you go. Absolutely. Absolutely. So for us, it's finding like when we did Lori Harvey, or we had Nikki Glazer in the magazine. We edit that. We decide what we want to go in the issue or not go into the issue, and then obviously that filters down to social, and digital. But I'll say this: we're pretty selective in who we choose to work with, and it's shocking. I'm not going to tell you how many issues of the magazine sold, but it's shocking that people want to be in this magazine. It's so aspirational. And I will caution you, we're not going to make money on the magazine. We'll get a little bit of royalty income, but that's not the story. The story is about getting those influencers to come in and working with people that have massive user bases, or followers in the millions. And to us, you can't buy that. I mean, you could buy, but it's really expensive. So we don't. Um, if you got some ideas, come on up. No, not yet. I mean, we're going to publish a magazine once a quarter. We're going to do one more issue this year, and it'll be in the kind of October timeframe. And then we want to get to quarterly, but we're changing kind of I don't want to say the look and the feel of it, but we want to make it thicker, better card stock, more pages. So I think we're going to go up to 296-page book. Because if you're only doing it once a quarter, you want to try and get as much impact as you possibly can. And we can do that because we don't have to pay for any of it. And maybe we'll include a fiction story for you. Tom Nichols used to write. Some of the best, journalists that we have today wrote for Playboy. You're absolutely right. It was. Yeah. So hopefully we'll get back to go ahead. Yeah, yeah. No comment. But yeah. All right, that's it. Thank you very much. I appreciate it.